have fun talking about a different form of alternative investing in this industry. Please welcome one of the leaders in the space, Rob Sechrist from Polaris Equity Group. Welcome, Rob.
Thanks, buddy. Great to see you.
Yeah. All right. So, y'all, I'm going to be leading this discussion with a much smarter man than I, and I'm very excited about it. So let's get started. Rob, who are you? Tell us a little bit about Pelorus first.
Sure. So I'm Rob Sechrist, the president and co-founder of Polaris Equity Group. We're an asset-based lender. Our specialty is doing value-add lending. We have originated more than 5,000 transactions for more than $1 billion. That was non-cannabis. And in 2014, when our local congressman, Dana Rohrabacher, passed the most consequential amendment in all of cannabis law or congressional bills out there, which defunded the Department of Justice from any prosecution of a cannabis-related business in a medically licensed state, we realized that this was the largest newly created asset class for real estate that had just been created, and we knew that we had the skills to build these facilities or put the tenant improvements in place that were necessary for them to have licensed operators. And so by 2016, we started originating transactions and became the first dedicated lender to the cannabis sector. And today we're the largest privately held cannabis-use lender out there in the country. And we've originated nearly $250 million in the sector. And by the end of the year, we're hoping to have had financed about 3 million square feet. So that's kind of where we're at.
Wow. That's a lot. That's a lot of numbers. So 5,000 transactions, but about, you said three?
In the cannabis sector, we've done 58 is the total as of today.
Fantastic. So we're excited to have Rob here today because you had a little bit of news this morning, correct?
We did announce this morning that we continue to be the first ones plowing the path through as a private lender in the sector. Today we announced an FDIC-insured specialty lending line of credit that we're able to now have a vehicle to make it more efficient for us to deploy capital. That's a line at 4.75% interest, the lowest of any debt ever issued in the sector by a regular bank. And we're really proud about that, and it's another first. The story to get there is a lot longer.
No, I would like you to add a little bit of color into the actual importance of that for you and how that's been missing.
Sure. So as a fund, you're raising capital and you've got money coming in, you've got payoffs coming in, you've got deals that are going to go out, and you never have a perfect match of capital for more than a couple hours in the day, if that. And so if you have a line of credit, you can be issuing a new deal out, and as a payoff comes in, it can be paying that down, and you get more efficiencies of capital. Without having that, we had to operate in a different mode, and it's just the most inefficient way you can possible, but you just make it work.
Fantastic. So there are different types of REITs, right?
Sure.
So, I mean, to my knowledge, there's 4-ish types of REITs.
Well, you know more than me. Most people have heard of a REIT, and a REIT owns properties, and you get this tax advantage of saving 20% on the tax rate for your federal taxes as dividend income, and you only are taxed in the state that you're domiciled in, which is a huge advantage for no tax states. And then if you have a self-directed, you have a REIT will cleanse the possibility of UBTI, a certain type of tax. And so most people are only aware of that type of REIT that owns properties. There may be other types, but I don't even know about that, so maybe you do. But we're a mortgage REIT, and a mortgage REIT we're a lender. We do not own the properties, and we just get the tax benefit of being an operating with the REIT structure in place. And that just means that we've got to just distribute 100% of our cash flow, 95% of our income has to be real estate related, and a bunch of other things.
Fantastic. So when looking it up, I read about a sector REIT. A sector REIT's very specific to like data centers or something very specific within an industry. So far, it seems to me a lot of REITs have been focused on grows and different aspects of that. Would you consider that somewhat sector specific, or do you see that broadening?
That's different than us. So if you're an owner, if you're a REIT and well, first of all, if you're launching a vehicle and you're going to be in the cannabis, you have to disclose that you're you're going to be in the cannabis sector because you're in a federally illegal zone. And so as an owner, you might be focused on those types of things. As a lender, we are agnostic. We are not necessarily looking to only do this type of transaction. We're looking at every single transaction across the country and picking the best transactions that we think are the best fit, best, most experienced operator, best, strongest sponsor with the best realty play out there. So I get the question a lot of times, what state are you looking to go in? We're not an operator. We're a lender, so we don't. We get the ability to pick a deal by deal, not trying to go into a state and compete where it's disproportionately not as good as another state because we need a footprint in that state. We don't need to worry about that.
And that goes for globally as well.
This fund is only able to be domestic.
Well, bad question then. Fantastic. All right, so you touched on the tax advantages of REITs a little bit. Would you like to dive a little further into that?
That's pretty much the high level. It's just those three main benefits for a REIT, for an investor, and it's why everybody comes in, is that you get that 20% reduction in your taxable income. Most REITs kick off, most commercial real estate debt funds kick off ordinary income. So if we can convert to being a REIT structure, that's a 20% tax reduction in the tax rate. That's a significant amount when our yield has been 15% every single year we've been in operation, and that's net of all fees as an IRR. So we just pushed out our yield today of 15.4% net annualized. That we believe that we'll be able to maintain those yields, and that was before which we launched 2 weeks ago. We were the first to do the bond and get Egan-Jones investment grade rated and those things as well.
First in many aspects. So, kind of switching topics a little bit here, how are REITs really about to deal with non-real estate related income from more equity participation?
This is a very complicated question, but I'm happy I've explained it to so many investors, and it's different from different perspectives. So I'm going to talk about it, how it applies to our fund, because we're a debt fund. And so what the rule is, what he's talking about, is a REIT has to distribute 100% of all of its income, and 95% of that income has to be real estate related. Well, in our situation, there are transactions where we have equity in some of these transactions. That equity is held at the manager level and is passed through to our fund members. So the fund never has anything directly plant touching. But what he's talking about is, how are we able to pass that equity through that and keep it within that 5% of non-related? Even though as individuals out here, you might think, well, it's part of the real estate. And from an accounting perspective, it's non-real estate related. It's a business, so that doesn't count. And so we actually have to take whatever that value of that equity is, and we're valuing it each month, and we are blending it in over the term of the loan, and that's being added in as accretive to our yield, so that the investors, before that liquidity event has ever occurred, are getting allocated their equity participation. It's called an unrealized gain. So there is essentially a phantom income that's being allocated, and your account balance is going up in that one category. Even if you were taking distributions, that one sector is a separate line item going up. And when there's a liquidity event, that sector that was unrealized gains now goes into capital balance. It just moves up on your statement, and now that's money that you could withdraw. That's as simple as I can make it. The one advantage of it is you're actually passing through what could be short-term capital gains or long-term capital gains as a REIT dividend, and that's pretty cool.
Fantastic. So I believe it's later today. There's a panel focused on real estate investment trusts. So, I think the main topic there is going to be focused around the importance of REITs in the industry and how you all have been able to assist the growth of so many major companies that a lot of these attendees are most likely invested in.
Yeah.
Can you touch on that? Just highlight a little bit.
So our goal and our peers' goals, even if they're a traditional REIT, is what we're trying to do here is we're trying to lift up this whole entire segment, cannabis operators, and reducing the cost of products and making it more accessible to the entire country. And how we're doing that is we're reducing the amount of equity that is needed to get these transactions off the ground. So before we came along, and even till to today, this is about a $50 billion asset class for just the real estate across the country once it's all built out. We know that because we did the data analytics. We built our own company to analyze this for every state, so we knew what was going on. It didn't exist. And so that, by providing debt, it makes it so that the owners of these businesses are not having to sell any more equity than they absolutely have to, and are minimizing that at the worst possible point for them to raise capital when that facility that we're lending on is not operational. Now the brand is operational, and it's a brand that's going, but that particular one is not operating yet because they're just building it out. So, you know, it would be much better to raise equity after you had that facility up and running. And so our goal is to reduce the equity requirements from the operator. And when you look at it from that perspective, it's a very advantageous way to go. In addition to that, another thing that we just announced is we just came out with our fully stabilized product now. So we are a value add lender. We do the construction loans. Now we can drop that rate down after you get fully stabilized, or we can originate new fully stabilized. So we're lowering our cost of capital. We've completed the first bond offering here a couple of weeks ago, and that's allowing us to now offer new products and to reduce the cost to the borrowers.
So debt and equity are intertwined, it sounds.
Yes, they are. You know, everybody always starts off with having to do something with some portion of equity. You know, you can get a really low cost coupon on your loan if you put a lot of equity up, but that's going to cost you over the life wherever you borrowed or how you raised that equity. That's a lot more expensive than if you got the maximum debt that you could go at maybe a 15% coupon, but that's only fixed on this portion of debt as opposed to selling 15% of your company forever.
So I have to ask, because Rob is one of the most connected people I've met in this space. Talk to us a little bit about SAFE and banking, and what you expect really this year. And I know it's not something we're going to touch on a lot at this conference, but I think Rob's insights are incredibly valuable.
So I was meeting with a peer this morning, and he had a conflicting or different perspective, and I was really shocked about it. But my perception is that we're not going to get anything in the near term. I don't see the SAFE banking getting attached to the defense spending bill. They lose leverage to get it passed in the next round. I am less optimistic that we're going to get deconfliction of state policy from federal policy in the near term as everybody thinks, but I don't think that it's as big of a deal as everybody thinks. There's the Safe Banking Act. You think, hey, it's got the word bank in it. It's gonna change banking. Everybody thinks there's no banking. There's enormous banking. Out of the 2,000 transactions we've seen in our entire time being in the industry, even since 2016 and before, we've never seen an operator not have banking. So that would be a massive red flag to us. So to say that banking is going to change because we're passing this bill is not the case. If there used to be 720 banks, now there's 694. They're on FinCEN's websites. Those are tier 1 plant touching banks. Those banks, the banks that are in are already in it. They built the compliance department to handle those deposits. I think that if you were to get the rules deconflicted and you were to get it passed, I don't see this mad rush of banks rolling out of compliance for that division. It's not worth it to them. So I don't see that happening. I would rather see targeted reform on getting 280E removed for legal operating cannabis businesses, or I'd rather see the cash buildup that's happening where it starts is the dispensary, because the dispensaries cannot use credit cards to process transactions because the credit cards use the federal system. So if you could just target those two things, you just massively inflated or made it the public companies more profitable for the federal tax filings. Everybody got more profitable because they can write off their expenses on the federal taxes. And getting rid, if your goal is to get rid of the cash, if that's the goal, then we've got solutions to bank it. We actually got to get rid of the buildup of it. So those are the things I'd like to see. But these are very strong things that everybody wants to run on in Congress. And nobody wants to just blow it out and get it passed, because then they got nothing to run for it and everybody donate to their campaign. I always say there's no power in yes. So, the longer they can keep saying I'm working on it,
Hitting it on the nose, man. Fantastic. So as we kind of wrap this up, tell us a little bit. I mean, you've had a lot of news recently. You've had a lot of great news for REITs in general and yourself, obviously. Can we expect anything else in 2021?
So we recently upsized our offering to $1 billion. I think that we'll get to that in our AUM in the next 24 to 36 months at the rate that we're going. I don't think that there's anything I can get out in front of it at this point, but our longer-term fully stabilized lending product is, I don't know if we've officially announced that yet, but it's out kind of now, I guess.
You're welcome.
We have always led the lending industry, whether it was in cannabis or non-cannabis, and we'll continue to do that. We'll continue to look for opportunities on how to reduce the costs of the total all-in cost to the cannabis operators out there in the country. And, we continue to pull in more and more data to understand this market better than anybody else there in the country. Each cannabis operator only has the transactions that they've looked at, even if you're the largest in the country and maybe you've got 100 facilities and you've looked at maybe 1,000. We've looked at thousands and thousands. And so we actually have more metrics than anybody to understand what's actually happening out there. But that's just because we're at the point of the flow of the information, and that information is so key to knowing what is the cost of goods for this? What is the tenant improvements for lights in this area? What does it cost in this area? And it's different in each region, in each state. So we track that stuff.
Very interesting. Rob, any last thoughts you'd like to leave our audience?
I usually have something witty to say, but I don't right this second. And if we have any time, I always like to have a question.
Would anybody like to ask a question to Rob? I mean, yes.
Yes. You mentioned that you evaluated the $50 billion market or asset class. Did I hear you say that you built a separate company to do that?
Yeah.
What's the name of that company?
That company is a proprietary company, and we don't license or give that data out. So, but I'm happy to tell you that that's what we've extrapolated out. So it's not it's too valuable to put that out to the we weren't even going to tell our investors for a long time, but the cat's out of the bag.
I might get in trouble after this. Anybody else? Any other questions that we can ask Rob? I mean, the man has insights on a ton of different aspects in this space. Last call for questions. Y'all, please give it up for Rob Sechrist from Polaris Equity Group.
Great job. Thank you. Great job.